Welcome, everybody. It is Sunday Cowboy Metals. We are broadcasting from the great state of Texas. So we like to have Cowboy Metals, precious metals with a little bit of Texan flair. We're going to be talking today about exchange for physical mechanism between COMEX and London. I'll get into detail on that. And we're also going to talk a little bit about what's going on with physical storage issues in the industry. I'm going to touch on that a little bit. I'll get more into that in a future broadcast. We're doing a lot of research. We're going to wait for people to load, let YouTube let people know that we are live streaming, and we will get into the topic here in just a moment. All right, I think we're just about ready to go. Hey, everybody, this is Rob Keynes at goldsilverpros.com. It is Sunday, April 18th, 2021. And as I told you guys at the very beginning of the broadcast, we are going to be talking about exchange for physical mechanism, that mechanism between COMEX and London, how it works, because we had a reader question by email this week. So I thought I would dive down into that a little bit. There's also been a lot of smoke around the physical storage industry with a lot going on Twitter. John Adams Economics and I have been talking back and forth privately over this, and we've seen a lot of data come out with some of those programs. Even Peter Schiff has gotten involved in this conversation. So we're going to actually just touch on that for just a moment. I'm going to do my research before I give sort of a more final or concrete opinion on that industry. I don't want to get into it too much right now. Hey, everybody, welcome to the program. I see Joanna C is joining us again. She says, Rob, love your programs. Thank you so much, Joanna. Appreciate you stopping by. I know you always have comments for us, so I'll look for you in the comments after the program. If you have any questions, just post them down there, and I'd be happy to answer them for you. What's up, Damien? How you doing, buddy? Greetings from Florida, Julie Newhouse. Thank you for joining the program. Brian Zarb, how you doing, buddy? Greetings from Denmark, Fabrice Necht. Hopefully I'm saying your name correctly, Fabrice Necht. Hayden Martin. You've got a question there, Hayden. We'll answer that here in just a few moments. Everybody remember to subscribe and hit that notification button. It really helps us get our viewer counts up on these videos and let us know how many people are really interested in the channel content. We love to see that growth on the channel. So subscribe and hit that button. Also, we have super chats enabled. If you guys have really pressing questions, you want to grab my attention and you want to ask me a specific question, topic, we will get into that after I do the main presentation. Throw that in the super chat there. I'll get to all super chats after we go over the EFPs here for about 20, 25 minutes. All right, I think we're just about ready to get started. IL Prepper, hit like to spread the word about Rob. Thank you so much for that. I appreciate it very much. I'll get to all of your comments. Start putting the comments in the chat. We will have a section for that here in a moment. I think what I want to do is go ahead and get started on the topic EFPs. So I had this question come in by email, and this is from Silver Redux from Wall Street Silver, one of the Wall Street Silver subscribers that's come over to our channel because we've been covering what's going on in silver. He says, hey, Rob, as you know, there are a few Wall Street Silver members following the COMEX activity, attempting to track contract settlements, withdrawals, open interest, and so on. Occasionally, EFP comes up, and I'm sure that most don't know how it works or affects the COMEX contract process. Would you be willing to do a brief presentation on how EFP works, so on and so forth? Yes, I would be able to do that, Silver Redux. So let's jump into that real quick. I'm going to go ahead and go to the share screen, and we're going to figure out exactly what the heck is EFP. Before I dive right into EFP, I wanted to take a look really quickly at the gold and silver price, because that's what we are. We are a gold and silver channel. And this is the Cowboy Metals Silver live stream. Again, this is contrarian investment advice with a Texan flair, because I live in the great state of Texas. It's what I call home. We had a nice little uptick in both gold and silver today. Gold is sitting at about 1777.29 according to gold price, and silver is up to 25.96. If you guys have subscribed to my member newsletter on my website called the Golden Quarterly, I went over these charts in great detail. I'm going to leave that for the subscribing members before I come back and do it later on in the program. So if you want my interpretation of what's going on with gold and silver and the potential for a gold and a silver breakout at the same time in the very near future, go subscribe to that on the website, and I'll show you guys that later on in the video. Okay, now getting on to exchange for physical. I want to talk about what the heck is exchange for physical. Exchange for physical is something you'll notice. I'm actually going to go to just the CME chart, and this is the U.S. futures trading on CME Group's website for gold, and you'll see this in both gold and silver. And if you haven't seen these charts before, essentially live on the website, or essentially live, I mean, it is kind of day by day data to some extent. They put, or at least live, they put the price. But down here, they put the day by day data on what's going on in a market. And one of the categories under trade type detail right here in this little column is something called EFP. That's exchange for physical. Now, what the heck is EFP and how does it affect the contract process? That's what Silver Redux asked me. Well, I'm going to explain that here for you guys. Essentially, it is a mechanism in which somebody can do a futures contract here in the US and they can get exposure over at the London market. Because as you may have noticed, and this is something really exciting I'm going to bring for you guys later, I'm working with one of my subs who's in FinTech. We're putting together a website with tons of information. In fact, he's already put it together. He came to me afterwards and said, what else do you want on there? We did a Twitter and a YouTube poll, and we're putting more information on there. So as soon as I get this up, I'll let you guys know. But getting back to EFP, because we're going to track it. But getting back to EFP, it's exchange for physical. So there is price arbitrage opportunity between, as you could imagine, the futures market in the US and the market there in London. And that price arbitrage opportunity allows traders to make a little bit of money on that difference, because not everything's 100% synced up. And when we get to displaying these charts online on the website, when we get all this data scraped and get it on this website, we're going to have one chart that's going to go over the difference between the London daily fixes, or 2 fixes a day, price fixes, or price targets, if you will, and the COMEX trading. We're going to have that all charted out over time for you. It's going to be really, really cool. I hope you guys stay tuned for that. Sorry, just getting my screen situated over here so I can watch you guys on the chat on my other computer. All right, so exchange for physical, again, is like price arbitrage between COMEX and London. And essentially what it does is, so let's say you have a futures position and you want to get exposure to the London OTC gold market, and it's somewhat, more physical market. Maybe you're not able to get the metal on COMEX, you could do it in EFP. And I'm going to read right here from the website as to what this is. We're going to read a lot of this because there's some really cool clues right off the CME Group website as to how the EFP is used. So it says here, gold futures from CME Group provide a deep and tightly quoted source of liquidity in the gold market and are used extensively to hedge over-the-counter physical gold business. So it's a hedge on the over-the-counter physical gold business. Now, in the London market, it's an unallocated market, meaning you have a lot of banks and players involved. There's only so much metal. It's unallocated derivative positions on top of that. And depending upon how many of those are basically the equivalent of standing for delivery or contracted for delivery at a given point in time, is how overall physically liquid it is. But from a derivative paper perspective, what they're saying here is that the CME Group, the futures, are used to hedge the over-the-counter business, the liquidity there. And it's really what they're talking about is the paper liquidity. So it says, while in the past, gold traders would frequently trade OTC with banks to hedge gold transactions, the majority of gold hedging is now conducted electronically with COMEX. The exchange for physical allows traders to switch gold futures positions, that would be on COMEX, to and from, so back and forth as many times they want, unallocated accounts, and quote on a dollar basis relative to the current futures price. So EFP is actually a measure of the difference between the London price and the COMEX price. And so essentially what that means is you're getting that price arbitrage, or that exposure, if you will. And EFP is calculated from these basic 4 things: the number of days between spot and futures delivery, the metals and currency interest rates, transportation costs, and refining costs. So in here, transportation costs, what they're talking about is you actually trade your futures position and stay, and don't trade back and forth, but you stay in the London OTC market. Eventually, you're going to want to take delivery, and that means there's going to be a transportation cost back. Why? Because the OTC market is to facilitate physical delivery. Now, there would be transportation costs if say you wanted to actually bring it over from London to the US, there may not be transportation costs if you're just going to leave it in the London vault. So that transportation cost could be a part of that, just depends. And then refining costs for good delivery standard bars. Now, why would EFP calculate in refining costs for good delivery standard bars if the bars are already there? Well, guess what, ladies and gentlemen, the London OTC market, the bars aren't already there. The OTC market is unallocated, meaning there are more claims on the bars than there are bars. So this is where they have to put in some of the refining costs for the new bars that are being sucked up by the demand by those OTC positions. So they're basically admitting here that London doesn't have all the gold. It's for production of gold that you come into that unallocated OTC market for. And with the EFP mechanism on COMEX, you can start with a futures position, switch it over to London, and then eventually get that bar, whether you want to leave it in London or have it transported over. So it's a way to go from a futures position to that London market. Now, some of the things that they contend in this page here is that London may be a little bit cheaper market. It is cheaper in terms of, I guess, cost to have it exposure to the physical. It's considered to be more liquid than COMEX because COMEX is really a futures market, which you can stand for delivery. But the London OTC is considered a faster physical delivery market, if you will, or a more liquid one. And so maybe the implication there being, well, if I can't get the gold delivered on COMEX, but I want it, I could go to London. Now, you could either play the price arbitrage or you could see it all the way through and go get the delivery. That's essentially what they're saying. I'm not going to go over quoting EFP there, but there's information on the website about exactly how that works. So I'm just going to leave that to you guys. It's CME Group, or if you just Google CME Group and EFP, you'll get this. Okay. Anyway, trading EFP. Or who trades EFP. This is the section I want to concentrate on. Now, I went over this about a month or so ago, and I kind of dropped a bombshell here, and I want to see if people pick it up. I'm not even going to say the bombshell this time. I'm just going to read through this and see if you guys pick it up. Okay. Banks prefer to be short EFP, meaning short the futures, meaning short on the COMEX, and then long on the physical. And that's as they get closer to futures expiration. Because what that does is it reduces their overall trading risk, if you will, the risk of trading in the markets. And rather than having to square the OT exposure systematically across wider spreads and with less liquidity, EFP allows traders to hedge the gold markets more efficiently. So what they're saying here is even though the OTC market is supposedly access to the physical gold, if you have a lot of positions either way, if a bank has a lot of positions either way, rather than squaring that on the OTC, they can use the COMEX to do it because the COMEX has more liquidity in terms of a paper basis. There's a lot of paper floating around the COMEX. We often talk about open interest, and I see somebody here asked about, Hayden Martin says, are we going to talk about open interest in the futures market? Yeah, let's talk about it right now. So if you go to the open interest in gold right now, the dominant month is June 2021, gold volume. So if you look at June 2021, right now there's 393,094 open interest contracts. I'm pretty sure not all of those are going to stand for delivery. In other words, that creates a lot of liquid paper or derivative price exposure. And that's what they're saying on the exchange for physical. EFP allows traders to hedge the gold markets more efficiently because there's so much paper on COMEX. And if you use that to go between the markets, it's a more efficient mechanism. And eventually you could also stand for delivery in London if you wanted to. That's a possibility. And that's where you would get your transportation costs or have to pay the refining costs to get that forward production gold in through London to actually get that bar, because they're basically telling you London doesn't have all the gold it says it has because they're unallocated positions. It's not where you're taking a position, the bar is already there. Some of it could be there. That's the liquidity of London. But if those OTC positions go really high, in London and through the exchange for physical through COMEX, they're going to have to get more bars in. That's where you're having to pay refining costs because they're going to have to melt the bar for you because they don't have them all right then. Okay. Traders typically run OTC positions with an offsetting futures position to be price risk neutral and to use EFP to manage basis risk. Basis is basically the difference between you get into a contract a couple of months and then as the contract expires, the difference in the value of that contract is the basis. Okay, that's what the basis is. I'm not going to get too much into basis. It's just a measure over time, if you will, and then we'll just kind of leave it like that. Here's the one I want you guys to pay attention to. I'm just going to read it. And I'm not going to say what it means. I want to see if people come up with it in the chat. Traders of exchange traded funds, that would be an ETF, like, I don't know, a GLD, an SLV, use EFP for arbitrage price arbitrage between the two markets. Okay. While authorized participants create or redeem ETFs. I'm not going to say anything. I'm just going to see if you guys catch on to what that sentence actually means. I've explained it before. If you've been following me on the channel before, you know. I'm not going to say it now. All right, getting on to gold. That's exchange for physical. So hopefully that answers your question. The reader that we had emailed in, answer your question about exchange for physical. Now we're going to actually see it on the report. So going back to open interest in gold, as of Friday, this is Friday's data, and you can change the date here. They'll roll 5 days of data. If you want older data, you actually got to pay for it. But on the website for free, 5 days of data, and the June is the predominant contract. That's what's going to help determine the price. Is the nearest term contract has predominant trading. There's 393,094 contracts of open interest. There were no deliveries for the April contract for Friday because there's only about 3,868 contracts left in April, and people didn't take delivery. But there were 2,691 EFPs. That means people went from COMEX on that June contract to either go stand for physical delivery on the London OTC ahead of time, because remember, you got to put your position in London ahead of time, because it takes time to refine those bars. So they're already starting to do it on the June contract to the tune of 2691. And this is just on Friday. And on every day, you'll see these EFPs. There's a lot of them. They add up. There have been more EFPs in gold and silver, that exchange for physical mechanism between the US and London in a given month, than there have been actual physical deliveries in the COMEX. That's another clue for you guys as to what's going on. I'm not going to tell you what it means. I want to see if you can tell me. You guys tell me, what the heck do that mean, Rob? You tell me in the chat. You tell me in the chat, and I'll see if you catch it, and we'll come talk about it. So essentially, that's what an EFP is. That's people saying, I'm going to leave COMEX and go on over here to London. Maybe they're wanting to maybe they think by the time June rolls around, they'll get that London bar faster. Or maybe they just want to do price arbitrage. I don't know. Could be either way. All right, but anyway, that's exchange for physical. I'm just going to pick one of the. Let's just pick Wednesday. Wednesdays have been really big for EFP in the past. I haven't looked at the data. Oh, there you go, 2,441 EFP contracts in gold. So there you go. So that's how the EFP mechanism works. Now, this is a rare case where on the April contract, you had 3,048 deliveries. That was actually more than the EFP mechanism. So apparently somebody wanted to deliver on gold in April. And that's out of 3,158 contracts. That's like 90-something% of the open interest in the April contract delivered last Wednesday. You think people wanted their gold? There's only 3,100 contracts, and almost all of them took delivery. That's amazing. And we're going to get into the deliveries for this month for gold and silver here in a moment for you guys. I hadn't covered this probably since last week. Last Cowboy Metals, I believe we covered this. All right, and that's what we do on Cowboy Metals. We cover gold and silver. Okay, so here's silver. Here's Friday's data. As you can see, 188 actual physical deliveries on the April contract for COMEX. You see right here, 188 for April, teaching you guys how to read this. The next biggest delivery month is May, the next biggest trade month with 83,000 open interest. Which month is now becoming the next? Because it rolls, it's constantly rolling. This is a rolling system. It's a future system, always rolling a contract from one month to the next. What's the next biggest month coming up? It would be July. So people are already taking contracts off. That's why you see a negative number here, 2,565, 188 deliveries, and then 2,400 just derivative positions rolled off. 2,112 on the same day came back in July. So there were some closures of contracts. There were some physical deliveries, and then the rest rolled into open interest in July. So it's probably, before we get to the end of April, July is going to be the dominant futures month. Right now, it's May. So we have 83,000 open contracts in silver. It's not a whole heck of a lot, but it's a fair amount. 1,540 EFPs. Again, exchange for physical, price arbitraging between the COMEX and London, or perhaps taking delivery. I don't know. We're just going to pick a Wednesday again. And you see here on Wednesday, you had 473 on the May contract and only 2 deliveries. So again, EFPs more than physical deliveries. How does that affect the contract? Well, if you're switching over to EFP, you're going to go into that London market. It's essentially taking the responsibility of the delivery of that contract, okay, off of the COMEX and sticking it to London. Now, as to how much it's actually going to pull the metal off of London, I don't know. Maybe they're price arbitraging. Maybe they bring it back to COMEX. Maybe they go back and forth. But at some point, when we see these high EFP numbers right here in gold and silver, there's gold. It means that people are going to another market to get exposure to the physical metal. I don't have the data to tell you the exact percentage, but it means that there's not enough physical metal on the COMEX. That's a sign. And I've been following this basically every day since last July. Now, I've followed this data over the last 10 years, but really since July, I've been like documenting, putting on YouTube, the whole 9 yards. I have not seen EFPs. I mean, the EFPs started in March of last year. What we have in March of last year, the shutdowns, okay, the start of the pandemic, the scare. The EFPs and silver went bonkers. Gold, it went bonkers for a while. Silver stayed there for a couple of 3 months. Then it kind of died. And this is a report I showed you guys of the silver. Then it kind of died down. And then boom, it has popped back up. That tells us in the last calendar year, there has been more demand for physical metal than we have seen in a very long time. Of course, I've also showed you like sales of American Eagles, okay, and how those in the first couple of months of the year dwarfed what they had been the last, I don't know, 5 or 6 years. I mean, the amount of physical demand in this market for silver and gold is really tremendous. It's been that way for about, more than a calendar year. I'd say about 13, 14 months. It's been that way. The silver has just been there. All right, let's go over to deliveries. If you want to go to deliveries, you could just Google this, or you can go to CME Group's website, the NYMEX COMEX deliveries. And I think we're on the monthly charts here. So we're going to look at the gold futures right here. We started off with a bang, hit 16,868. You saw the 3,048 number I showed you for the 13th. I believe that was a Wednesday. So total this month, we're up to 25,260. That is a whole heck of a lot of gold. That's about 2.5 million ounces, because you just move the decimal place over 2 zeros, because it's 100 in each contract. So you're looking at 2.5 million ounces. That ain't too shabby for what is considered not the hugest delivery month in traditionally in gold history. You'll see the deliveries pick up in the summer. That's a hint for you, especially in silver. Look at July in silver. Look at deliveries in July. Last July, we had a pop in silver because they had massive deliveries. What do you think is going to happen with the silver squeeze movement in silver this coming July? It's going to be massive. It's going to be bam. All right, here's silver. We start off kind of with a bang, 1693. Now this is 5,000 silver contract, 5,000 ounces, but we're at 2797. A fairly good delivery month. Not bad for silver either. Wanted to show that to you guys. I'm going to really quickly go over the COP report. I don't want this to get too long, guys. We're already about 23, 24 minutes into it. So the commitment of traders report. What about, Rob, the commitment of traders report? That is the CFTC reports all the groups of traders that play around in the futures market and their aggregate positions. And we like to look at the long report so we can kind of break down what that means. And this is as of, I believe, last Wednesday, April 13th. Is that Wednesday? I think it's Wednesday. Somebody correct me in chat. We're going to look at just gold and silver here. It has the other metals. You can see it has platinum and palladium. This is silver right here. So in this part of the chart, you'll notice that the swap dealers, which are the bullion banks, we think of them as sometimes the negative energy or the evil entities in the market, depending on what you want to think, have increased their short position by 1,500 contracts. And as a percentage of all short interests, are at 27.5. It's actually not too bad. I've seen them starting to reduce their short position in silver, which is a sign that the bullion banks think that there's going to be a price pop coming. In other words, it's a bullish sign, and they're trying to reduce their overall exposure to shorts in the market when that happens. When the price goes up and you're holding a bunch of shorts, you be holding the bag. First, people are going to take delivery off of you if you don't have it. Plus, you can lose money on that contract. And that's about all. I mean, if you look at the rest of the data, you saw managed money go a little bit long in silver, 2,000 contracts. A lot of people are lining up for increasing prices. There we go. Let's go to gold. Gold is next. Gold right now, the swap dealers are sitting short 200,000 contracts in gold. That's 43%. Okay. When the bullion banks are short 43% and the producers who are producing it have their own short position, they're short almost 20%, 18.8, 86,000 contracts. It's not for the producers. The producers have their own category right here. This is the producer category, okay? The swap dealers are not shorting just for the producers. Do they have some producer clients? Sure. But they're doing it for themselves or for other large entities, and they're short on gold 43.7%. That is a very concentrated short position. That tends to hold gold price down when you have those concentrated positions, when you have very liquid, massive entities putting that much short paper on the market. All right, that is going to be the gold and silver report, and that's going to be exchange for physical explained? Thank you for the question by email from our WSS follower. I want to get briefly in a moment to the problems we're having with the physical storage market. I'm going to pay attention real quick, however, to the chat. Thank you, everybody, for coming in. Daniel, Salav, Dude Boy, Robin Kelly, Silver Stacker. Thank you guys so much. Super chats are available, guys, if you want them. If you want to grab my attention, jump into the super chats, and I will answer questions here in a moment. Dude Boy, I see that you have one. I will get to those here in a moment, but I want to go back to the presentation, and we're going to go over the potential issues that we're having in the delivery market. So a lot of you have seen John Adams and his tweets, perhaps, on what's going on in the physical storage providers. So these, I'm not talking about the OTC market in London or the COMEX or the exchanges. I'm talking about you go out, you find a company, you want them to store your gold or silver, you sign a customer agreement with them, you buy it through them. Typically, sometimes you can ship it to them, but typically you'll buy it through them. They'll store it. They'll tell you it's allocated. They'll tell you have XYZ amount, and then you go to redeem it and you have some issues. There's been a lot of smoke around this. And so I'm starting to ask a lot of questions of people that I know that are offering these services and expecting answers. So prior to offering my end opinion on this, because I got to do the research, we're a research site. I don't want to spread misinformation. I did, however, want to show you guys something I'm putting in the Golden Quarterly. So the Golden Quarterly is a subscription service. I typically never show my subscription service in public, but I'm going to break a rule. This is so important that I'm going to show you about a page of my quarterly subscription service called the Golden Quarterly, because it's so important. You guys need to know. So this is about a page here on the website of the spring 2021 Golden Quarterly here at Gold Silver Pros for paying members. And this is where I talk about the unallocated gold and silver storage programs. I don't right now know who all the culprits are, who the bad guys are, the good guys are, how bad it is. I'm saving that, but I want to read to you what I wrote in my quarterly, because there's some recommendations for you. If you guys are storing gold with somebody, pay attention to what I'm about to read to you. It says here, I'm briefly going to cover the unallocated schemes using gold and silver industry, but we'll cover it much more detail next quarter. So if you guys are interested in getting the raw details on this, next quarter, you'll want to be a subscriber before then, so you'll see it, because I'm going to cover it in the Golden Quarterly. It's disturbing to say the least, but let's get into my recommendations. It says, for now, I would be extremely careful storing your metals with even the most respected companies. And if you're considering storing your metal at a depository institution, at the very least, follow the following recommendations. Make sure the firm has and promised fully allocated and segregated storage. Both of these terms, when used together, not separately, not individually, together at the same time. That's the key. Pay attention. Mean that your metals are your metals and no one else's, and that those bars with your serial numbers will be returned to you when you request them. If you do not get both in writing, then you're likely in some sort of pooled account in which many people have a claim on a single bar. When the music stops due to physical shortages, it is then very likely you will not be able to redeem the metals, and further, there may be cash shortages, which leaves you holding the bag. Second, make sure the company has at least an annual audit with a published result by a reputable auditor, not a fly-by-night auditor. And the result, here's the key. You don't necessarily want a local audit firm unless they're very reputable. You want somebody that has some reach, that has a big reputation on the line. You don't want mom and pop local accounting firm. I'm sorry, it's just not good enough for these purposes. You want the attestation letter for the audit to be specific as to what procedures were used to confirm the physical presence of your metals. If it doesn't have that attestation letter, you need to call your provider and you need to get it. Okay, because that means they either didn't do a physical audit or they don't want to publish the results of that physical audit. And if it's fully allocated and segregated, you want to know. Okay. Further, the audit should match serial numbers from the computer system as to what they say you have, and they show you when you log into your account for a sample of clients. So take, 100 clients, take 8 to 10 or whatever. Go take the computer system records, match them up with the actual physical bars sitting in that cage where they're storing your metals. That's what you want. And thirdly, you want the company to guarantee that you can drive to that storage location and get it. If they don't let you take immediate delivery, it's quite likely they don't have your metals. Because why would they care? If you paid for the metals and you paid for the storage and it's fully segregated and allocated, why would they care if you came and picked them up? They've already been paid for the storage. If you're picking it up, that clears up their storage for somebody else, and if anything, they should probably refund you a prorated part of your storage fee, but they maybe don't have to. It makes them a little bit of extra cash on the side, right? Why would they care? Why would they stop you from taking physical delivery? That's all I'm going to say on that topic right now. I'm not going to go into specific companies because more research needs to be done. Now, guys, in this Golden Quarterly, I've got my precious metal stock reviews. I've got two brand new, well, not brand new. One I've been following for a while, but a brand new one, and an update to the one I've been following a while in the letter. I've also got my precious metals reviews and the economic state of the union. This is 33 pages long. It's the longest Golden Quarterly I've ever written. And if you guys want to be subscribers, you can get to it on the website. You just basically go to the website. You can go to the front page if you wish. You can click on Become a Subscriber, and those options are there. And not only do you get the Golden Quarterly, you also get the Gold Silver Pros University, where I have almost 40 lessons on basically how to manage your money, finance and money, economics and markets, legal considerations, precious metals, a whole section on precious metals, real estate future prep. All right, that's all I'm going to do as far as the advertisement goes for my site, guys. Appreciate you joining the channel. And now, drum roll, it is time on Cowboy Metals to get into the question and answer session. And I'm going to run over here to my computer. Remember, you can ask these in Super Chat, and I'll prioritize those because they pop out at me. Sometimes when I have to scroll through the chat and I've got hundreds of comments, I may not grab yours. I'll do my best. But if you hit me with that Super Chat, I guarantee I'll see it. All right, let's go to the question. Let me pop up the screen. And let's see who has a question. Alan Oliver, at the current rate of deliveries and ETP swaps, how long would it take for the COMEX to run out gold and silver? That's a good question, Alan. Nobody knows because, one, I don't trust their data. Even if you look at their data, they have, in silver, hundreds of millions of ounces, and in gold, millions of ounces, right? So it appears as though they have liquidity, but we've seen signs that those numbers aren't correct. So at this point, even if I ran the math calculation for you, I don't know. John Adams and I, on our video last week, where he and I were talking about this, we suspect in the next couple of months, there's going to be another big smash, especially on silver on COMEX, but gold's going to start happening is my thought. Silver is going to go short first and then gold, I think. When that big smash comes, it could be anywhere from 80 to 100 million ounces. Because remember, last July, we had, 83, 84 million ounces? It's going to be bigger this time. You got Wall Street Silver jumping in and the apes over there. You've got people paying attention. The broader market is paying attention. Whereas it was just us, precious metal bugs back in July. So it could be even bigger. So you could see in the next couple of months, it come under tremendous stress. And remember the signs. Remember what happened last July. JP Morgan had to bail out COMEX with 30 million ounces of silver in one day, moving from eligible to registered, registered being the category you trade on futures contracts. Remember the EFPs went crazy for several months. Okay, remember the reports from Andrew McGuire that COMEX is telling people don't take delivery. Just think about all those things. Those are signs of stress. All right, another question says Urban Sombrero. Have you heard any news about clients using Kitco synthetic fractional reserve silver program? I have not personally, although I do know a lot of people have contacted me with stories about other people. So yes, people have been using Kitco. Now it's a pooled storage. Pooled storage means it's not fully allocated. And if you go to Twitter, I've tweeted some things about that. Go through my Twitter timeline. There are definitely issues in which some people who purport to be Kitco customers, certainly they're saying they're Kitco customers in public, have had issues getting their metal. That's just what they report. Again, I don't know myself because I haven't ever tried to do it. I'm going to go back through and see if there are other questions. Guys, remember, we have the Super Chats open if you want to jump in on there. Questions. Jeff Keller, thanks, Rob, for making stuff I don't understand more understandable. You're welcome, Jeff. That is my role. That is what we do here, and I appreciate the kind comment. Anders A., who is always in the chat. Thank you, Anders, for joining just about every program. Is it backwardation in the silver futures market now? Backwardation is when the future silver price is lower than the current price, meaning typically over time, you'll ask for higher prices because there's time risk in there. You don't know what's going to happen. That drives prices up. This is true with like stocks, bonds, everything. Is it backwardation if the current price is higher? Yes, it's backwardation if the current price is higher. Are we actually in backwardation? Let me go look. Let me go look. Which specific one did you ask about? You're asking silver. Let's go look at silver. Is it backwardation? The spot price is somewhere around 25.96. We're looking at the futures and the last settlement from, let's go to Friday's settlement number. It's at 26.04 on the COMEX. It's at 25.96 and the current price. So the futures price is higher. The last settlement, major settlement for May was 26.105. Nah, it's not in backwardation. Right now, I don't see it as being in backwardation, the silver market. But good question. Thank you for asking, Anders. I appreciate it. Going for more questions. Anybody else ask any new questions? Ukbay comes in here with the $5 contribution. Thank you, Ukbay Nguyen, so much. If more liquidity flows into precious metals, is that deflationary? Deflationary towards the price? Potentially, yes. I mean, certainly when you have more money coming in, it depends on where the money comes into the cycle. If money's coming into the miners, it's going to drive up their valuations, and supposedly they'll be able to finance more operations. You'll get more supply eventually. If more people are demanding the end product, the actual physical metal itself, then no, it should raise the price. I don't think it'll be deflationary. You mean from like an economic perspective? No, not in itself, because I would say that people react to precious metals as a reaction to what's going on in the economy. So from an economic deflation perspective, if the economy is deflating, a lot of times that can mean you're about to have massive inflation. And people are like, no, you can't have inflation and deflation at the same time. Yes, you can. Okay, we've seen it. We saw it last year when the economy shut down and we had higher prices. If you have economic deflation, it means less people have jobs, less people have income. That means you can have a bid up for the precious metals potentially. It really depends. There are a lot of things that could go into that equation. Gosh, I could probably write a term paper on that. Good question. It just depends on the situation. It really does. Alex Wright asks, what happens once silver goes parabolic? One would not want to trade physical back to fiat, right? Well, we just borrow an AGAU. Well, that depends on your particular situation. If you have bills to pay, like a mortgage or a car or something that's in a fixed interest rate or a fixed payment, and you're able to sell a little bit of your silver or gold, which has price, we're assuming it's gone parabolic, you can pay that off. Maybe that gives you your car. Maybe that gives you your house. It takes care of that for you and gives you financial security. Maybe that's what you want to do. It just depends. If we're going to hyperinflation, I would be careful, because if we're going to hyperinflation, it means the money's on its way out and the precious metals may be your wealth. So you want to get rid of money first instead of sell precious metals. But a lot of it determines on how long that takes in your particular position. Cool Breeze says, hooray, Cowboy Metals. Thank you for joining the channel. Cool Breeze, you're always in here. Hit me up on Telegram and Signal later. I've got some stuff I want to talk to you about. Thank you for joining the program. Jim WDDS asks, how do numismatics do in gold bull market? Might they be treated differently by governments and bullion? Jim, I'm so glad you asked this question, because guess what? We got to go back to the share screen here, guys, because I have, for my subscribers, of course, we'll share screen. If you go to my website and you go through the university, we talk about numismatics. So if you go in the precious metal section, our guide to numismatic coin investments is course 4.7. So yes, we do cover numismatics on the channel. And so to your question, your question scrolled off. So I'm not going to see your question because it scrolled off, but I'm just going to answer it. Numismatics can be fantastic. Some people are voraciously against numismatics. Oh, it's a scam. Get your gold and silver as cheap as you can. Well, I disagree. If you look at charts, there are two basic, really cool charts. If you go to my university, you'll see them. There are two charts I've got there, which shows numismatics do really well in times of shortages of the metals, because when people can't get the cheaper bullion stuff, they go to numismatics. Does that mean numismatic prices automatically crash when there's abundant metal? No, because it's a different animal. The numismatic will never fall below the metal content of that coin, because at its very least, it's still a gold or silver coin. On the other hand, There is a set of collectors which love the history of these coins and love the rarity of these coins. And if you have a rare coin with some history that is in pretty darn good shape and it's got an MS grade on it, that coin's going to do very well no matter what market you're in. And so what you see in the numismatic coin market, you could have gold and silver bouncing around. It's bouncing around because of industrial demand, or it's bouncing around because of what's going on in the economy. That numismatic line is like slowly creeping up. The numismatic at many times, can be a much more stable market. If you want to know how and you want the proof, go subscribe to my website, become a premium subscriber, go to 4.7 in the university, and I teach exactly how that works. It's got all the information there for you. It'll answer your question. All right, Brian Zarb came in with a donation via the super chat. Love my super chats. Thank you so much, Brian. And his question is, where would you most likely expect a black swan event to come from? Bond market, bad economic data, or maybe from the crypto market getting overheated? Oh my God, that is such a great question. Brian, that is a fabulous question, because I love the crypto aspect of that. When we talk black swans, it's things we don't expect. What's everybody talking about right now as a black swan? Deutsche Bank, Credit Suisse. James Anderson from SD Bullion was on my show. We talked about the $5 billion charge Credit Suisse is about to have to account for. But are those really black swans, or are they gray swans? Because we're talking about them. The definition of a black swan is something you don't see coming. Could the cryptoverse, specifically the stablecoins, which Dezo on our Friday night interview says is a giant Ponzi scam. And I tend to agree with them when you look at the actual data. And I know that's going to get the crypto spammers all over my channel hating me, but I don't really care. That stablecoin universe is a complete Ponzi, or at least 90% of it, we believe. And so, yeah, that could cause, I mean, look at how much money is going into crypto right now. That could cause a major crash. Now, does that take out the economic system? I don't know how many institutions have it. Think about the too big to fails. How big is Deutsche Bank and JP Morgan and Bank of America and all these banks into crypto? I don't know. Some, yeah. They're creating their own cryptos, really. The private cryptos, I don't know. Could there be individual losses? Hell yes. Could that cause unemployment and problems? Yeah. Would that be a black swan? Not quite yet, I don't think, because we don't have Fed coins officially out yet. Now, if the Fed coins crash, yeah, because you're talking about currency crashing. Private cryptos, maybe not. It's not quite big enough. Okay, not quite big enough. Abstract Fitness comes in with a donation. Thank you so much, Abstract. He has the question, Barrick versus Newmont. Which do you like any better? Thoughts? Thank you. They're both majors. Honestly, that's a tough. There are pros and cons to each. Each one has the same problem, essentially. They're trying to replace ounces. And when you have a majors trying to replace ounces, and especially when a lot of the easy to find primary and silver and gold mines have been found, you got to either go to these polymetallic mines or bid up and pay more for a primary mine, because in the market, you're bidding against everybody else. And so a lot of the deals they've been doing the last 2 or 3 years, and Rick Roll had a comment about this a couple of years ago on another program. A lot of the deals are doing, they're paying premiums for these companies to replenish their ounces. So they're both fighting the problem of having to pay a premium to maintain their ounces. Are majors great? Do they get the first bid when money comes into the gold and silver miners ahead of the juniors? Yeah. But are they under constant pressure to keep that share price up to replenish their inventories? Yes. And that is a problem for them. I don't know that I love either Barrick and Newmont for that reason. If I'm going to go hunt around in the gold and silver market and I just want stability, I'm going to gold and silver. I'll just do the metals. If I want stocks, if I'm building a 401k, am I into Barrick and Newmont? Sure. I'm not in the 401k. Sorry, guys. I'm more looking at some of the near-term producers as my sweet spot, or some of the early stage exploration, which could be the huge pops. You saw like with Great Bear in 2018. And by the way, I talked about Great Bear and the history of Great Bear in my stock review in this Golden Quarterly. So if you want to know the story of Great Bear and a company that's following in their footsteps in the same region, in the same district in Canada, which might also find another Dixie, potentially, we don't know yet, go subscribe to my premium newsletter. We talk about it. I kind of like that end of the market too. Personally, I wouldn't be either in Barrick or Newmont. But if you are really interested and want me to do a detailed dive into both companies for you, I do have a consultation service. You can go to my website, click on the top where it says consultation, and sign up. It is a paid service, but that's where, paying for my time to do a deep dive, and I'll do a deep dive for you. Hopefully that answers most of your question on Barrick and Newmont. John Schmidt, thank you for the contribution via Super Chat. I appreciate it. He says, could institutions hypothetically slam silver prices and buy SLV to take physical delivery of silver at reduced price? Yes. If you're an authorized participant, you have 50,000 shares. Is that what it is? Yes, you could. You could. That's possible. I think when there was but I think the opposite happened in like January from the perspective of when you had that bid up in SLV and you had that 110 million ounces come in those 3 days. I think it was like the last business day of January and the first 2 business days of February, if I remember correctly. 110 million ounces over those 3 days went into SLV. That actually bid it up because of demand. And then the next week or so after, I think it was something like 50, 55 million ounces, I believe, came right back out. It was like the tide had literally turned. You know, the earth had rotated, the moon had rotated, the tide had turned, and it went right back out. Half of that in the subsequent week. And I do think that was a way for them to put money into SLV and get silver. They weren't trying to slam the silver price. I think they were so damn desperate for the silver. They bid up SLV, and I don't believe all those ounces went in. I believe most of them came out. That's my own personal opinion. I can't prove it, but that's my personal opinion. Could they slam silver prices to buy SLV and take delivery? Yes, they could, and that would be a really nasty thing to do. I think we're so far along in the potential shortage of silver that they're past that, though, and they're just going to throw fiat dollars to get the silver. But they could slam silver. They could go to COMEX and slam the silver price down, go to SLV and take it. Sure. I mean, that you can do that, and that would be a nefarious thing to do. But, you know, do we put that past the bullion banks and some of these other moneyed entities? No, I don't put that past them. All right. I have answered all the super chats. Man, guys, you guys are awesome. Thank you for the super chats so much. So much gratitude. Thank you for joining in with Gold Silver Pros. Okay. I got to do my Wall Street Silver segment. I'm going to do one of these every Cowboy Metals live stream, the contrarian investment advice with a Texas flair, every Sunday at 1 p.m. Central Time. And I want to share with you, if I can get my screen to come up, I want to share with you this Wall Street Silver posting. We're going to pop on over. This is absolutely hilarious. I love the memes. Missing, and typically in the back of a milk carton, you'll have a picture, but in this case, it's the SEC's enforcement of security laws and regulations. Have you seen me? If found, contact the FBI. Awesome. I love it. Dude, it's so much fun. I love this channel. We've started posting more on Reddit on Wall Street Silver. If you guys want to see notifications of our videos, if you want to see content, I've got, we're doing this. So we're on Reddit. We love it. They're at almost 60,000 subscribers. That's awesome. Congrats to Wall Street Silver. Great meme here. If you guys want other memes, go to Wall Street Silver. There's a ton of them. Getting ready for the 420 raid. So in a couple of days, a shout out. The raid is on the physical silver market. The apes are going to hit it in just 2 days. So if you want your physical silver, you may want to make your order before all the apes get in there. Okay. Upcoming, we are going to have an interview with Paul Harris. Stay tuned for him. He runs a conference down in South America for the precious metals miner. He's an expert in the industry. He's been a newsletter writer and has written for some very prominent publications. That will be coming up this week. We're going to record that, I believe, Monday morning. So we may pop that out either Monday, Tuesday, or Wednesday. We'll have to see. That's upcoming. We are going to have more for you on the channel this week as well. I'm going to come back to the precious metals. And remember, by this time next week, I'll have done more research on the storage end of the market, and we're going to give you more there. Oh my goodness. I came back to the super chats, and Generic 03 gave me $33. Thank you so much, Generic 03. He says, thanks, Rob. This is Eric M from email. Please alert the bugs to the presence of fakes. Will do. Eric M of email. Oh my goodness. I have to go now. See, now I have to go look that up because I get tons and tons of emails from readers. Eric, let's see if I can find you really, really, really quickly. What I may have to do, Eric, I may have to come back and do this in a separate thing because I literally have so many contacts from my readers, hundreds and hundreds, but I'm going to try to find you. I'm going to do a search for Eric M. Anyway, the presence of fakes. Eric, pop in that topic. I think we've been talking about it over email. Eric, where are you? All right, I'm going to have to follow up on this, Eric, because I'm literally looking through hundreds to the presence of fakes. But I'm going to say that you either mean the fake coins or the fake people doing storage. And yes, there are fakes in the market. I promise you, however, thank you, Brennan Lewis, for the contribution of 99 cents. You didn't have a question, but thank you so much for doing that. The presence of fakes. There are fake coins in the market. Some of them come out of China. There are testers you can use to assay them. If you're doing business in the physical, you want to make sure that you have some of that test equipment, or you have a local trusted dealer who will do that for you. Presence of fakes in terms of the schemes designed to get your money and potentially hold it in storage accounts. Yes, there are fakes out there. I know what you mean. People out there who are proposing to be gold and silver advocates who may be, shall we say, controlled opposition. I think maybe this is I think I remember this conversation. Controlled opposition, people that purport to be gold and silver people, or true honest money people, or free money people, or not part of, say, I don't know, the establishment, government, or financial industry. Yeah, there are fakes out there. There are people out there who, and you can find them. Hell, I'll just do it. I'm going to name drop here. I've said Jim Rickards a bunch of times on my show. I'm going to get a lot of crap for this, but to me, I've seen him speak in person, and I've seen what he talks about. He advocates all the time the SDR, which is part of the IMF, top of the monetary food chain, if you will. He talks about IBM Hyperledger and the relationship with IBM and that crypto. He talks about a lot of things that to me seem to be establishment points, talking points, establishment goals, if you will. I'm wary of him. I don't have anything concrete on him. I've heard on my program, let's just do it this way. On my program, Rob Kirby has called him out and thinks he's basically a pretender. I've heard Jim Willie on many YouTube programs call out Jim Rickards. I'm calling him out for a different reason, because I think he talks about stuff that fits into the control mechanisms in the existing monetary system. I'm just going to leave it at that. So maybe that's what you meant by fakes, Generic 03. I think I talked about all sorts of fakes. Hopefully I covered your question there. Sorry, again, thousands of emails this week, but I think I covered it. Any other questions? There's not going to be that much left here. I don't see so many other questions. Thank you, Fast Eddie, for joining. Silverstalker for joining. Ron Shuckleson is in. Dude Boy, Anil Rai, Ruth Daglow. Generic says, yes, controlled opposition advice, too many sense to squeeze. Yes, there are a lot of controlled opposition. Be careful. Be careful who you listen to. That's his point. Look at everybody. If there is somebody that you feel, and there were some bombshells over Twitter, go back to my Twitter feed. If there is somebody you feel has been a gold, silver, and free money, honest market advocate for a long time, who is maybe you think shilling or selling something that's maybe, I don't know, like an unallocated gold program, hint, 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 or talking about things like SDRs and FedCoin and establishment propaganda, you have to look at that person and say, is this the wolf in sheep's clothing? Is this the proverbial Trojan horse? I'm going to leave it there. I think I've answered his question. All right, guys, I think that's going to do it for the super chats. Thank you so much. We had a bunch. We had Ukbay, we had Brian, Abstract Fitness, John, Generico 3, and Brennan. Thank you guys so much. I think it's going to wrap up the question and answer session of this program. We've been at it for almost an hour. Again, I've talked about the guests I have coming up, Paul Harris. We're going to do more content this week. Stay tuned for that. Live stream schedule every 1 p.m. Central Time, Sunday. The live stream of Cowboy Metals. We're bringing contrarian investment advice with a Texan flair, because we live in the great state of Texas. Thank you very much. Until next time, this is Rob Keens with goldsilverpros.com.